You can hear me now? Okay. It's a football night. I'm the one to kick the ball. I'd like to welcome you all and open this first lecture of the Synergy Smaller Companies Fund. We've invited three great managers from Europe. Emeric Preaubert, who's Director of Investments and founding members of Sycomore Asset Management. Nicola Ricolfi from the Italian part of the fund, and Álvaro de Lázaro, whom I'm sure many of you know, founding partner of azValor Asset Management. Apart from being responsible for the management area of their businesses, they're all fund founders and investors in their own company. So that makes sense. Those managers who have the ability to generate returns and who have the skill to make good investments, it's only natural that they should invest in their respective companies, bringing together investment management and business management, even though this may lead to some conflicts of interest, but it's also a good thing. We're holding this conference at a time when this kind of investments is very relevant. We are 6 companies that invest in different countries, and I think that it's a good example of this style of investment. Whether it's fad or fashion, well, we don't know. Even though there are more and more management companies that make this type of investments, what this fund proves in its years of experience is that we're talking about an added value investment. The fund was launched 13 years ago. The 3 of them that will speak today, together with Avaron and other companies from Benelux and Germany, they have proven to have human teams that generate a lot of value. That value has been achieved in good times and bad times. After 2008, some of the members of the management teams had returns of 88%. The previous year, most of them had big losses, but reality shows that in these 15 years, the few people who invested at the beginning of a fund have multiplied their investment more than 4 times the original money they invested. Of course, in the meantime, there have been good times and bad times. This fund's value management in general, we believe, is a long-term strategy, and just like good wines, we're talking about buy and keep type of funds. And we can see this in the 15 years of existence of a fund. Many of you know us, but you didn't know about this fund. But it's a fund that in the last 15 years has been managed very methodically with a 10% annual return, but it took 15 years to get the first award. This year it's been awarded by Expansión as the best fund in the Euro area. And in spite of the fact that it's not very well known in the Spanish market, it has been quite successful so far. So I'll leave you in the hands of Mr. Álvaro from Sycomore, which is a fund manager that hosts the funds, although there are 6 companies in the fund, or 6 funds in the fund. Each of the speakers will speak for 20 minutes. Nicola and Emeric will speak in English, Mr. Álvaro in Spanish. You can ask questions in writing, and we will address them to the relevant speakers. And after the event, we will have a glass of wine, Spanish glass of wine. Without any further ado, I'll leave you with Mr. Álvaro, who will talk about Sycomore, which is a company that hosts this fund. Good afternoon, everyone. As Beltran said, I'm just here to tell you a couple of words about Sycomore Asset Management, because there are many people who may not know it. A lot of people, Sycomore is a French boutique in Paris, founded by 4 founding members who from the very beginning focused on in-depth analysis of European companies. They were also very much influenced by the fact that they focused on institutional customers, so their standards of company valuation and management was very thorough from day one. And through this company analysis process, they decided to set up the Synergy Fund, which we're here to present today, together with 5 other fund managers from Europe. The aim was to invest in smaller companies, places that Synergy could not reach with the depth of knowledge that those local managers could have. Since then, Sycomore has had a very successful track record. Over 18 billion euros invested, most of them in equity, European equity, and with a very sound customer base, mainly French institutional clients, but also retail clients and clients from outside of France, from Spain, from Italy, and other countries in Europe, where they also operate. That's all I wanted to add. I think with this we can start, maybe with Emeric, who will present the fund.
Gracias, Beltrán and Gonzalo. Buenas tardes a todos y muchas gracias por su presencia.
Good afternoon to one and all. Thank you for your presence. It's a great pleasure to be in Madrid. This is not my first time, but it's the first time that I participate in a forum like this, making a presentation with my colleagues from Nextam Partners, Nicola and Álvaro. I would like to thank Álvaro for organizing this event. Now I will speak English from now on. I will just make a brief introduction in Spanish, but that's it.
To English. Okay. So, Sycomore. As Gonzalo said, I will be very short on the presentation because you already made the presentation. I'm a co-founder of the company alongside 3 other partners. We started the company in 2001, being a very, very little startup, managing less than 10 million euros. So it was really, really small, and it has been slow to grow, but we are very patient people. I think when it comes to investing, you need to be patient. And we have built our track record, our investment process, and today we manage slightly over 8 billion, the bulk of it in equity, but we also have some bond funds, credit. We don't buy government bonds at this stage at Sycomore. And we have a range of funds ranging from, I said, fully invested equity, flexible fund, as well as long-short products. I will stop here about Sycomore and just say a few words about our investment philosophy. I know that everybody here knows very well azValor, so I will be very quick. If I mention fundamental investing, value investing, Benjamin Graham, common sense, not listening to the stockbroker, and not paying attention to short-term stock price movement, I'm sure you know what I mean. So we share this with, I would say, a fundamental and very classical type of investing, concentrating and focusing on stock picking. I would like maybe to stress what makes us probably a little bit different from many of our peers. You have on this slide a scheme what we look at when we invest in a company. Because over the last 10 years, the investment team has been tripled in size. We were around 7 fund managers 10 years ago. We are today 22 people in the investment team. And we follow the exact same number of companies today as 10 years ago. And we, unfortunately, work as much. It means that our goal is not to follow the biggest number of companies, but to know them better and more and deeper. And what you see on this slide is a summary of our investment tool, which means that when we invest and when we look at a company, we spend a lot of time working on its environment, on its stakeholders. And our model, and the name is a little bit, I don't know if it's not funny, but it's marketing at least. It's called SPICE. And SPICE means the 5 pillars that we look at. S is for suppliers and society, P for people, I for investors, C for customers, and E for environment. And you can notice immediately that the I of SPICE is at the middle of the word. It means that, yes, we do pay a lot of attention to the environment of the company, but the center of the analysis, of course, is the business model. And I would say the business model of the company. To summarize, I only have 2 slides on our investment process, which again is very classical, but very, very processed. Typically, the team makes around, I have the number because consultants always ask how many company visits do you do. Honestly, I don't care, but we have been asked. So we have here the result. Typically, we have around 2,000 company meetings every year. And I would say that all investors spend time with the company management, the CEO, the CFO, the IR, and we do that. But we also spend a lot of time with external partners of the company to have a different view, a different angle. And typically, we like, before investing in a company, and I know that our friends from azValor, and I guess Nextam as well, do this, we like to talk to competition. We like to talk to customers. We like to have exchanges with suppliers. And very often, I organize, and the team organizes, meeting with former executives. When you talk to the CEO, to the IR, they always give you the nice side of the story. I have it on the website of the company. I want to have the nasty side of the story. And for instance, we have from time to time exchanges with executives who have been fired by the company. And they say, Emeric, you know, I probably have a negative bias because I've been fired and I may be in legal fight with the company. So what my opinion will be negatively biased. And I say it's exactly what I'm looking for. I have the positive side. I want to balance it. So to sum it up, we are very classical investors. It's no rocket science. It's just hard work, dedication, and broadening our vision not only on the company, but on its environment. When it comes to the fund, I will stress a few investments that we have, and I will make a very short conclusion on the fund and the prospect for the fund going forward. If you want to have some insight on the macro condition in France or in Europe, or what we see for the market, I'm really sorry, but I will not comment on this because I've noticed over the years that I am very, very bad, and we are very bad at Sycomore forecasting the economy. In a few words, if I don't have any view on the economy, but I have a view on where we are on the market. Our view, and I will be very quick on it, is I'm not especially excited by the valuation of indexes today. At least in France, every single strategist is highly optimistic when it comes to investing in equity, which in my view is not necessarily a good sign. We have had 7 years in a row of positive return. I don't want to be pessimistic tonight, just tell you what I think. So I don't have a particular, I'm not excited by the indexes. That's maybe the bad news. The good news is you have indexes in Europe at least, which are at 1 or 2% from their historical highs. The CAC 40 just reached this week its highest level since 2007. So basically, indexes have reached quite high level, but indexes do not reflect the reality. And you have many, many companies that are 20, 30, 40, or 50%, and in some cases more, off their peak. And we do find that maybe there is not a lot of value in indexes, but we do have a lot of convictions on the individual stocks. And in my view, it is what is the most important. When it comes to a few examples, I put in the presentation 3 names, but I look at my watch. I won't comment the 3 names because it will be too long. I will focus, just say a few things very quickly, and focus on one, which is ALD, that probably shows the way we invest. First name, because I just want to give you some information of what you have in your fund. Maison du Monde is a retailer specializing in furniture for homes and decoration objects. At the time of the IPO, 2 years ago, Sycomore was the second largest investor in the company after the PE fund. It took us a long time to invest because we all know that these are very competitive categories. IKEA and many, many names, the fashion effects, not mentioning online retailing. But in that case, we discovered that the company has a very specific model, has had the ability to offer different universe in terms of decoration that have a big appeal to consumer. And it's very uncommon to have in a market, and speaking historically, this company was only in France, or mainly in France. In France, the furniture market was basically flat or have very limited growth over the last 10 years. And this company had double-digit organic growth, which is quite impressive. And they have continued to deliver a lot. The second, so very intelligent model, growth prospects in France and outside of France, because today they are starting to roll up in a number of European countries. And last point, it may sound a little bit tactical, but it counts sometimes. The CEO of this company, it's a 1 billion company in sales, so it's a very small company. The CEO of this current CEO of this company, his former job was CEO of Elior. Elior is a 150,000 employees company, number 4 globally in catering, behind Sodexo, Compass, and Aramark. And before that, he was number 2 of Carrefour Group, and he was head of Carrefour France. Carrefour France is 30 billion in sales. So I had extensive talks with him when a guy that was leading a 30 billion companies leads a 1 billion company and is 60 years old, which is young, but is his last position. There is a reason. And he told me, Carrefour, it's so big, I cannot do anything. This company, I can make a difference on the size. And he has a huge incentive on the stock. That was, as I said, maybe a little bit tactical, but it counts a lot to have a highly incentivized management. Another example is Direct Energy. When we make the presentation, this company has been in the fund for a lot of time. It's an alternative distributor of electricity in France, benefiting from the liberalization of the market against the behemoth EDF. And the stock, as you can see, has had a tremendous run, growing tenfold over the last 5 years. More recently, last year, the share price came down and we increased the position in the fund. I won't comment too long because this company, I don't know if it's unfortunately or fortunately, will exit the portfolio because the company has been taken over by Total, the energy group, a few weeks ago, and we will tender the share because the offer price at 42 euros is very close to our own target price. We had a sum of the part of 41 euros. And sometimes I used to say stock market is a stupid animal short term, but long term, when you make a decent analysis and you have rationale, basically you can, I mean, it's a little bit lucky to have, a coincidence, but not a coincidence to have a target price so close to the offer price, but that really, in our view, reflects the value of the assets. So we will tender the shares. Last company, and I will stop here, is ALD. It's an interesting case because it's highly controversial. So it shows at Sycomore we are not systematically contrarian investors, but we do dare to go against the herd if we think it's in the interest of our investors. ALD is a very simple business. It is a subsidiary of Société Générale, and you may know that being a subsidiary of Société Générale is not typically a good point on the stock market. It has been, SocGen has been one of the worst performers on the French market over the last 10 years. ALD business is financing car fleet for corporations. So the business may be called boring. It's not high growth, but it is growing because they open new countries, because the penetration rate of leasing is increasing. So it's a single-digit growth, but let's assume 5 to 7% plus a little bit of operational leverage. So not huge growth, but I would say very visible path and very limited risk, because when you have Repsol financing its car fleet through ALD, the credit risk, it's never zero in life, but it's so close to zero that there is absolutely a very limited risk. At the time of the IPO, I said this example, the company market cap is 6 billion. Société Générale floated 20%, which is a little bit more than 1 billion, 1.2 billion free float today. At the time of the IPO, we bought for more than 100 million euros shares, and we became the second shareholder after Société Générale. So it's in the Synergy fund, but it's as well in many, many different funds at Sycomore. And it was IPO'd at around 14. We have a target price of 17, not huge, but like 25-30% upside plus 4.5 dividend yield annually. It's not that bad. And as you can see, it has not been really, really smart, because a few months after the IPO, the share price went down 25% in a growing market. And at the same time, the stock market was up. So what happened? That's the interesting thing. ALD financed fleet for its customers, and the customers today require diesel cars. I don't know exactly what is the mood in Spain about diesel, but driving a diesel car in Paris is probably the worst thing you can do after a terrorist attack. It's really something that has a totally negative perception. And 85% of the fleet of ALD is diesel. And ALD said to us, we finance the cars that are required by our customers. If they want us to finance gasoline car, that's fine. If they want us to finance hybrid car and tomorrow electric car, and it's what will happen in the future. In the meantime, the market is very scared about the loss that ALD will make when they will resell their fleet. And what we think the market has not understood is the company has been very clear. Historically, 90% of the profit came from services and credit margin when they finance, and 10% on profit on secondary sale of the fleet. And they said at the time of the IPO, given the price pressure on the secondary market currently on diesel car, this will go to zero. But when you lose 10% of your profits and the share price goes down from 16 to 12 or less than 12, we call that a bargain. And actually, it was the most, in our portfolios across Sycomore, it was the most highly shorted stocks in all our universe. 25% of the float was shorted. And quarters after quarters, the company showed that actually the results were exactly in line with what they said. They don't make as much money on secondary sale as they used to do historically, even though it was only 10% of the margin, but they still do profit. And the short base is starting to reduce. It's been from 25%, I checked last week, to between 13 and 15. I think it will continue. And the share price has recovered a lot. It's a very simple story, but I took its example to say that even a boring, very visible, simple company can be shorted and can be drawn down because some macro view or some hedge funds say, okay, it's a thematic stock for shorting diesel in European cities, let's short ALD. And in my view, it was a false assumption, and we'll see in the future, and it is still a big position in your fund. So I stop here with just a final remark. We launched this fund 15 years ago, and we are very proud. And the fund manager here, of course, we have very close links over the years, and we are more than partners, I can say friends, and we are very proud at Sycomore to have the same partner, the same fund manager that we had in 2003, 15 years ago, and they trust us to follow us in this fund, and we are very proud of this. And every 2 years since 2003, we have the same question. Don't you think, Emeric, that mid-caps, small caps are expensive? It's always, and today I have the question, is it expensive? My answer is always the same. Frankly, the universe of mid-cap today, is it expensive? My answer is yes, it is expensive. It is a fact. I'm not saying it's a bubble, I'm saying, and some companies are expensive. But the real question, in my view, to invest in such a fund, it's not, is it expensive? The question is, do you find growing, decently managed company in Europe, in the mid-cap universe? And as far as the French compartment is concerned, my answer is yes. And since we launched the fund in 2003, we said, what our aim is to grow the fund, the NAV, at the same pace at the profit rate of the company. And over the last 15 years, the average growth rate of the NAV, with some bumpy road at some times, as you know, has been 10%. I don't forecast the future, but I hope that we will be able to deliver the same kind of performance, not next year, not this year, I don't know, but over the long run, because at least for the French compartment, we have a lot of convictions on very well managed and not too expensive companies. Thank you very much.
Well, I won't even try to speak some words in Spanish, as I'm totally unable to do that. So, good evening, everybody. Thank you to azValor and Sycomore for inviting me and giving me the opportunity to introduce myself, Nextam Partners, and a few ideas about Italy at the moment. And first, more than that, thank you both to azValor and Sycomore for our long-term partnership, which, as Emeric just said, is now 15 years old, and thank you for, let's say, sharing the same investment values that we use for our investments. My task today is to give some comments about investment outlook in Italy. This is always a difficult task because it's always difficult to speak about Italy to non-Italian investors. Well, normally there is no reason to provide an encouraging picture when looking at Italian things from the top. As we will see, public debt is extremely high in Italy. Economic growth remains sluggish at best, and the reform process that you have been witnessing in Spain, for example, over the last few years, never really manages to take off in Italy. So it's quite discouraging from a top-down perspective. At the same time, Italy's economic backbone is made up of a large universe of mid-sized businesses, which are often global leaders in their niches, very competitive, very productive, and growing very profitably. And the stock market always reflects that. Looking at general indices, it has been, as I say here, a kind of melancholic exercise over the last decades, but careful and patient stock pickers have always had abundant options available to invest successfully. So it's a kind of two-sided medal, as every medal, and I think this ambivalence remains true today, maybe even more true today than in the past. Trying to be slightly more specific. Well, there's little to say about Italy's long-term general unattractiveness to investors. Equities in general, on average, have been unfriendly, returning, I would say, nothing in nominal terms over the last 10 years, while European markets were doing relatively well despite the horrible start of the decade. And most recently also the bond market started to falter as the spread between Italy's and Spain's long-term government bonds demonstrates, having increased by almost 1% over the last 5 years. By the way, just as a reference, Italy's 10-year yield, which is now above 2%, now exceeds also the Portuguese one by, I think, 20 or 30 basis points. So we're really talking about a kind of unattractive overall environment here. And of course, there are sound explanations behind such uninspiring returns. Briefly, well, the obvious one is the level of public debt. While Spain, for example, is finally managing to improve the long-term trajectory of its debt-to-GDP ratio, Italy remains unable to do so, despite its very high starting point. And as of today, Greece remains the only country within the Eurozone featuring a debt-to-GDP ratio higher than the Italian ones. This is, of course, very important to remember because such a situation makes Italy on paper, but not just on paper, I fear, a perfect victim of a rising bond yields environment as the one we have entered into in this period. To be sure, there are several and important moderating factors. The private sector, unlike the public one, is still healthy in financial terms. Most of the public debt is in domestic hands, which makes its refinancing slightly easier. And overall, Italy still features a primary surplus. But notwithstanding these factors, it is clear that Italy is very exposed to a further and sharper change of sentiment on the bond market. The second big issue regarding the top-down outlook in Italy is the lack of growth. The Italian economy remains somehow burdened by a weak domestic demand and is still far away, unlike most of the other large euro area economy, from its pre-financial crisis levels. In general terms, weak private consumption and low public investments, which are being held back by the high public debt, have been offsetting exports, which on the contrary have been quite brilliant. And finally, it is clear that both issues, high debt and no growth, would require a convincing political leadership able to engage in a credible and deep reform process, similarly to what has been happening in Spain. But as you may know, Italy is currently literally trapped in a political stalemate. We have a highly proportional system which delivered a fragmented and hung parliament more than 2 months ago. Therefore, negotiations to form a new government so far have been successful and unsuccessful, and we find ourselves today with basically two main options. The first one is to see Italy acting as a sort of experiment within the euro area, as it will be the first large euro area country being governed by a populist and strongly Eurosceptic government, an experiment that we are not really anxious to go through, but that's a very possible option as we are learning in these days. Or if this solution doesn't materialize, The only alternative left would be to see this just-born parliament being dissolved and a new vote being called, but with the same proportional voting systems, which does not promise well in terms of finding ourselves in a more stable situation after these new elections. And in general terms, it should be underlined that the kind of popular support that these populist and Eurosceptical parties enjoy keeps growing day after day. And this, of course, given the, let's say, the macro situations I just briefly described, is a serious reason for worry, in my view. So in short, Italy is a highly indebted country which is not managing to grow overall, which would require the big shock coming from a credible political leadership, but such leadership is very unlikely to materialize, at least in the next future, and therefore I think it would be an impossible task to promote Italy as as an attractive top-down investment. But my point is that we should ask ourselves whether this depressing somehow viewpoint is the right one we should take to judge investment opportunities in Italy. And my answer is no. Why? Well, first of all, the private sector, the manufacturing sector in particular, here there's a small typo on the slide, it's my fault, where it says France, you should read Italy, is a strong exporter. Italy, it's interesting to see how the different countries have been behaving since the financial crisis, and Italy not only features a significant trade balance surplus, which is the third one within the euro area after Germany and the Netherlands, but Netherlands is a special situation as there's a lot of activity going through its ports, so the trade figures are not that significant. Basically, Italy is the second trade surplus country within the euro area after Germany, and had an improvement in absolute terms similar to that experienced by Germany over the last 10 years since the crisis. And in general terms, if we're just focusing on the manufacturing trade balance, Italy ranks fifth worldwide after this large exporting economy mentioned here, which makes you understand that this is the, I would say, structural and long-term feature which differentiates Italy from other weaker countries within the euro area. Italy has a very solid manufacturing base, which is and remains very competitive. The two charts here, I'm sorry, they're in Italian, but shows you the concepts. On the left-hand side, you see the domestic revenues of the Italian industrial sector over the last 10 years is the blue line, which you see is sharply declining and never managed to behave like, for example, Germany or France. But on the left-hand chart, you see the international revenues of the industrial sector, so the revenues generated by sales on the non-domestic markets, and you see that Italy has been comparing over this long period pretty much like Germany. So the exporting sector is strong and keeps becoming stronger. Obviously, on my presentation, but here we don't have the Italian market index, but the index of the small to medium-sized companies, which have been providing exceptional returns, even better than those provided on average by the other markets I was referring to. This abundance has been witnessed by many specific investments that, by the way, have been pillars for many years of Synergy's Italian portfolio. You see pharmaceutical stocks, which did much better than the most widely known pharmaceutical stocks in Europe, or a very successful investment we managed to do within the beverage sector, which again compared very well with European peers. Another very successful investment within the chemical sector, which compares extremely well with alternatives available in Europe or in other niche sectors like hearing aid. These are just few examples to show that despite the worrying top-down situation I was briefly describing, Italy, as always, and I'm sure will continue to provide very, very interesting opportunities for stock pickers like us. And to end my short speech, just a couple of, without going into details, of ideas we are working at the moment while we're trying to recycle a bit Synergy's portfolio, and two ideas which have some issues in common. These are not, first of all, they're not very well known. They're tiny, they're really small caps, pretty illiquid, but I like illiquidity when I'm buyer of a stock. I'm a very patient buyer. And in the first stages of a new investment, liquidity normally provides a very nice entry points. They're completely unresearched, unnoticed. So it's a series of circumstances and features which normally point to the same conclusion that nice companies see their stock undervalued on the stock market. The first one I like just to mention today is Equita, which is a local investment bank with a very long and successful and profitable story, whose activity is focusing on the mid and corporate segment of the Italian industry, which is exactly the profitable segment I was mentioning before, which went public a few months ago, so it's a recent addition to Synergy's portfolio, and which in our view will both benefit from the macro strength I was just referring to, starting from a very moderate valuation base. And the second, again, a tiny stock whose market cap is below 100 million euro, which again is a very recent addition to Synergy's portfolios, and which shares the features of significant growth, strong exposure to non-domestic market, strong capacity to generate cash, which is reinvested in the business or in acquisition, and with a very moderate valuation compared to the averages that, as Emeric was saying today, are a little uninspiring. Final one, it's interesting because it's been in Synergy's portfolio since day one, so it's been there for 15 years without interruption. It's Danieli, an engineering company, a great long-term compounder, which returned in excess of 11% per year over the last 20 years, while the market overall was flat, which has been doing badly relative to the market over the last 5 years, and therefore which today I think still provides a compelling entry point for value-oriented investors. But while the first two ideas are, as I said, are very recent additions, I'm happy to show a stock which has been there for 15 years with no interruption and is likely to remain for a long period of time in the future. And I think this is it. Thank you.
Muy bien, pues yo voy a ir.
Very well. I will speak a little fast so that we have more time for Q&A. I'd like to thank Emeric and Nicola for being here. A simpler way of putting it is saying that this is like a joke. A Spaniard, a Frenchman, and an Englishman who get together to invest. They've been doing it for 15 years. Sorry, a French, an Italian, and a Spanish investor who get together. And all managers want to make money. In each board meeting, we have rankings of who's first, who's the last. As Nicola said, those who do badly will suffer from it. And some of us, well, or some people have been kicked out and have been replaced. This is synergy, people who bet their own money on the business, and every 3 months they explain their convictions. For us, since we invest, we always have more money invested in global assets than in Spanish assets. It's great to be able to check with Nicola the thesis on Daniele, which is 2.5% of our fund, or to talk to Dominique or Emeric, the stock of any French company. So it's a very healthy ecosystem. I don't want to take too long. The structure of my presentation is to talk about Spain. I think you all know Spain. There's very little we can add. To know how a country is doing, you just have to look at the degree of socialism or liberalism in a country. Spain is doing as badly as other countries, but it's doing a little better because we've been less socialist than other countries. So there's no reason to be very concerned, although there are concerns every day. The high level of debt, the government influence in everything, in every business, in every sector. And the way to protect ourselves against them is to have real assets. Interventionism and socialism only lead to inflation. So the way to be protected is to run away from fixed income or bonds. But I don't think we need to add much more about the economy. When it comes to companies, I'd like to talk about one of them later on. If you want to learn more, you can ask me during the Q&A session. There are other 2 companies that I could talk about. I'm going to talk about Elecnor. I wanted to show this as a showcase of how we choose a company. First of all, we're interested in qualitative data. After 20 years, if we don't like qualitative features of a company, we're not going to buy shares of that company, no matter how good it is in quantitative terms. Elecnor is a company that for 60 years has done everything right. They develop projects, telecom, energy, gas, environmental projects, and they've done everything right in an industry where the rivals have not done so well. Their competitors are Isolux, Abengoa, but Elecnor for many years has not cared about the dramatic problems of the industry in 2008 and at the beginning of the 90s. Why has Elecnor managed to do better than the rest? Well, it's not very complicated to explain. Elecnor is a company that is very prudent. Its corporate culture is very careful, very prudent. What is prudency or carefulness? Well, it means not getting involved with very new countries, very new technologies, or countries you don't know. And this company, Matrix, is the one that has killed the others. Also, it's a company that doesn't run the risk of investing in what they don't need to make money. Elecnor doesn't want to act that way. And not only that, but the incentives of all employees are not based on contracts, but on other things. Employees of Elecnor, and I about 20 executives from Elecnor, and I don't know anyone who hasn't worked for Elecnor for at least 20 years. The average seniority in the company is 20, 30 years. So that gives you an idea of how anchored that corporate culture is. It's an extraordinary company, and the advantage is that this company, which is so extraordinary, we would never be able to buy it at the price that the market offers today. If we go to Cantiller, the holding company of Elecnor, and we were to tell them that we want to buy at 13 or 15 euros, they're going to laugh at us. Why? Well, I'm not very good at this, but let's understand its valuation. Eleanor has two businesses, a traditional business where margins are falling a little bit because there's a lot of pressure from infrastructure players, sometimes concessions, and we believe that margins are falling down to 6.5%. And this profit, well, it's 10 times, and this gives us a valuation of the company. The traditional business has no debt. With the money they've earned, they've created a mutual fund. They invest in concessions and infrastructure, just like we could do. And all of this is free. What is free? A series of megawatts of wind power in Brazil and Spain, network or grid transmission assets under Cielo. This is valued at 13 euros per share. The number here is slightly slower, but it's 13 euros. The current value, this is the current value, or the traditional value, and then we have those megawatts. But there's something even more important. The management team of Eleanor, with their track record and their geographic presence, at a time when we thought that commodities are gaining weight, we thought that the emerging middle class in Brazil, Chile, Colombia would invest a lot in the next 10, 15 years. There's going to be a great need of infrastructure in Latin America, and we believe Eleanor is going to take advantage of it. It's true, and this is a but. Well, sometimes Eleanor clients doesn't want Eleanor to get into those businesses. But Eleanor will have to say, if we have some wind megawatts, I'm not going to take this away from Iberdrola. So there's a growth projection which is really wild and huge, which hasn't been valued yet. Eleanor was at 22, 23 euros several years ago. Now, 8 years later, is 50% less. But today is a better company. This is a type of companies that we have in our synergy fund. And the question is, how do you find such cheap companies? How is it possible this should be so simple? Well, it's relatively simple. You just have to be very patient to buy and then wait for the market to acknowledge that growth. So it doesn't take a lot of merit. And these are companies that are not covered by an analyst. If you wanted to imitate us and buy shares of Eleanor, there's no list or index that covers it. No one knows it. It's not liquid. It's uncomfortable because buying 100,000 euros is a problem. We've invested a high percentage of a capital in this company, buying slowly but surely 500 shares a day, etc. Eleanor is a company with the greatest weight in the Synergy Fund. There's a comment in the presentation about Euskaltel, but I'm not going to explain that now. If you want, we can talk about it during the Q&A. Bertrand told me that there's a revolving mic you can use to ask questions. Thank you.
Sí, estupendo.
Hello. Thank you very much, Emeric, Nicola, and Álvaro.
Nicola and Álvaro, we're going to proceed with the questions. And the first question is, how do you split the total assets and the management of the fund within the different portfolio managers?
Okay. I don't think. Okay. Okay. You mean at firm level for?
No, at the fund. How do you split? How much is assigned to France, Italy, Spain?
Okay.
So
Okay. Yeah. Actually, we made a decision at the creation of the fund. We all know that German market is bigger than the Italian or Spanish market. It's not our point. Our point when we created this product was to have access to the biggest convictions of very, very experienced fund managers in their own countries. So we wanted to have access to Spanish convictions, Italian convictions, Dutch, French, and not playing a macro game, because a traditional mid-cap funds is much bigger in Germany and France versus the rest of Europe. It was not our point. So the answer is very simple. It's equally split. That's the basis, the starting point. And then we meet on a quarterly basis. It's a very free meeting where we exchange our ideas, our vision on the home market. And during these meetings, we can change the size of the different compartments. If a fund manager says, I have a lot of convictions on my home market, and instead of having 20% of the fund, may I have 25%, we are fine with this. And I remember very well, it's an old example, but we have memory that at the end of 2006, Álvaro and Nicola were among the only people I met in this investment community saying there is a huge bubble in Southern Europe. In France, everybody wanted to have Southern Europe funds, and it was the worst moment to own them. And they told us, frankly, we are not excited by our home markets. We don't have any convictions. So if we can allow more money to other parts, it's what we did, allowing more money to the Dutch part. I won't say that Dutch equities did great in 2008 and 2009, but they did much less bad than Italy or Spain. So it's purely based on the conviction on any fund manager. And to end, sorry for being too long, but it's quite important. Every fund manager has the same economic interest, whether he manages 15%, 20%, 25%. We don't think in, okay, I have a lot of ideas, I want to manage more, to have more fees. It's not the way. We require more investment firepower if we have ideas, otherwise we leave the money to others. But basically, equally split, modulo this slight evolution of the life of the fund.
Thank you, Emeric. To complement your answer, a very good answer, just to inform that Germany today represents 28%, while Italy is 20%, Spain is 17%, Benelux is 16%, France is 14%, so you're clearly subsidizing the position, not subsidizing, giving part of your stake to Germany, and emerging is just 4.5%. Okay.
Totally.
Por complementar, diría que hace muy poco,
To add to that, less than a month ago, we asked for more money and they gave us more money. Just to close the circle. You gave us 2 or 3 additional million. Because we had a lower allocation and because of the fact that we had strong convictions, they gave us more.
Stocks do you buy, or are you allowed to buy per country? And I add to this question, if you could explain the change that we agreed on the 10th anniversary of the fund and the impact of that measure that it's embedded in the answer.
Well, I think the idea over the last few years has been to go towards a higher concentration of the portfolio. As Emeric is explaining very clearly, the idea here is to promote convictions and to be, to some extent, agnostic about benchmarks. Therefore, now we all have, I would say, the goal to reduce the number of holdings we own in our own market to about 10. This is, but again, there is no rigidity. It's not a strict constraint we have to stick to. For example, in Italy now we are holding 12 or 13 stocks. So I would say around 10, then depending on the opportunities arising. But over the years we've been moving towards a more concentrated structure, which over time is likely to make the portfolio overall slightly more volatile, but we're happy to accept such slightly higher volatility in exchange for the stronger returns that over time having our best convictions at work will deliver to investors.
If I may add one thing to this, it's very important what Nicola said. And when we launched the fund, we realized that a typical small cap fund owns 70 holdings, 80 holdings, and is managed by a single fund manager. What does it mean? The 70 years conviction of a fund manager, it means nothing. In this fund, what we want to have is, as you rightly said, very concentrated fund. We want to have access to the 10 strongest conviction of Álvaro, the 10 or 12, we don't mind if it's 12, 13, or 9. We are pragmatic, of course, but we want to have access to this, and as well as in France. So we have a reasonable, at the end of the day, a reasonable diversification, because we have these 6 compartments, but each compartment reflects high conviction from the fund manager, and it's in our view, a very important feature of this fund.
Okay, this is a question for the 3 of you. And it's how do you select your positions? You select the cheapest ones on a universe of high-quality companies, or the highest quality company in a universe of cheapest companies?
Bueno, si empiezo yo, elegimos aquellas de las que estamos más seguros.
We choose those that we are more convinced about. And the fact that we meet with friends and partners every quarter, and that healthy intention that we have of having the best portfolio makes you develop the highest convictions. So we want high certainty and low prices.
Both issues, quality and value, are very relevant. I have been changing a bit my attitude since the big crisis. And I'm now, well, it's difficult to specify percentages, 60% quality, 40% value, the other way around, but I'm now more inclined to look at quality first, to put quality in the first place, as you know, the financial crisis has been exposing the weaknesses of many investments which were supposed to be cheap, but eventually we learned that such cheapness had sound justifications in weaker than expected fundamentals. Therefore, I would say that as far as I'm concerned, a good assessment of the quality of the business is at least the starting point, and I do that very, very simply in a rather scholastic way, maybe trying to adapt any company to a Porter matrix. But again, I remain very strict as I can on valuation, which is very important as well.
And as far as we're concerned, we have a quite established process to build a portfolio. We have 3 main features that we look at before entering a company. We call it the 3-star approach. First star is, I joined Nicola, is fundamental quality. We start by this. We want to have to be comfortable with the company's prospect, balance sheet, management, so quality. Second is, of course, upside potential. We have a target price for each company we follow. So we, of course, concentrate on the highest upside potential. And the third one is probably the most difficult to assess, and I don't have a crystal ball to explain, and sometimes we prove wrong, but the third star is called momentum. It is our confidence in the short-term ability of the company to exceed the market expectations. So that's quite difficult. As I said, we are long-term investors, but even a high-quality company, undervalued, if it publishes bad quarterly earnings, I don't feel too nervous. But if you lose 20% because you bought it at the wrong quarter, we try to avoid it. We are not able to avoid it every time. So it's quality, discount versus intrinsic value, and momentum, short-term momentum. And if the 3 stars are lit, as we say, then it's a big position in the portfolio.
Kurt, on the first 15 years, the fund has returned a 10.5% annualized. What should us investors expect in the next 15 years?
Much more than that. I'm kidding.
No, I hate to answer to this question, but I basically mention it as a conclusion. My first goal, we always said what the performance of the fund should be in line with the growth of the company. that we have within the portfolio. At some time it will be quicker because the market is more optimistic. At some time it will be much lower because there is a crisis or some fear about equities. But long term, it should be in line with the average growth of the company. Over the last 15 years, the fund managers have been able to find company in average 10%. I'm very, very cautious when I say that because but I see no reason why we should not achieve the same kind of returns in the very long term.
Bueno, en mi opinión la pregunta está mal hecha. Me da la tasa de inflación, yo le digo.
I think the question is badly put. It's not the same depending on inflation. There's no reason not to have inflation plus 10%.
This is a question also maybe for the three of you. No? Which are the reasons behind your bet for consumption?
Excuse me?
There is a bet on the fund on consumption companies. Is a reason behind that?
As far as I'm concerned, any sector bias or any let's say macro feature of the portfolio is just a consequence of the single choices I make on single companies and single stocks. So as far as I'm concerned, there's nothing in terms of top-down analysis or top-down convictions. It just comes out as a consequences of bottom-up decisions.
Sí, en nuestro caso no es especialmente un sesgo a consumo.
In our case, there's no bias to consumption in the Spanish portfolio. There's more bias to raw materials, industrial companies like Helignor. So in our case, we have no bias to commodity companies. But it's not a top-down decision. It's as a result of a bottom-up analysis.
Same thing. I won't say again that it's pure stock picking, so we don't have any sectorial approach. And actually, as far as the French compartment is concerned, naturally the diversification occurs because we have many different type of companies, but it's not a criteria for us, the sector.
Do you provide the performance attribution per country at the fund level?
Yes, absolutely. Sorry, I answer because we only have the hand on the French part, but we made the measurements of the different compartments, and we have a risk team at Sycomore that analyze not only for this fund, but for all a range of products, the attribution of performance by country, by sector, because it's a question. We have an overperforming fund because you have small cap or large cap at some points. And in this fund, yes, you may have an overperforming fund because you have small cap or large cap at some points. And in this fund, yes, look at it very much because a quarterly meeting and a quarterly performance is meaningless in my view. So we have the information, but it's not very useful.
It comes daily.
And we can have, yeah, I don't look at it on a daily basis.
No, but
Even quarterly.
If I with the performances of the single portfolios.
Okay. In page 21 of the presentation, we have handed to the attendees, you can see at least the difference between the best and worst performance per year, which is not the information you're using, but at least you've got an idea of how large the difference between the best and the worst per year is.
Well, this is a question regarding the different indexes in Europe. Which one is your preferred for this year? I suppose that it means that it's the country indexes. Which country do you think is going to perform better this year, the index?
No clue. No clue for me.
No idea.
No idea really.
And also, if you have a view on the euro-dollar in the medium term?
No view.
Sorry.
No interest in this.
That's a good one. As the fund is constrained to invest in companies up to 2 billion euro market cap, so the small mid cap, is there any difference or big difference between your process when you approach a small cap or a large cap, and they specify on the analysis or on the source of information you get before you get the decision to invest or not?
No, for me, no, the process is exactly the same. Obviously, when you analyze a small company, you're more on your own because external research is not widely available. But as I said, I'm very happy with that. That normally means that good companies are undervalued. But the quality assessment and valuation criteria are the same as far as I'm concerned.
Bueno, nosotros valorar un negocio,
If we were to assess companies differently depending on their size, that would be a problem. So we do exactly the same. There are companies that there's more information about, usually the large ones, and there are others about which there's less information, but they're usually more manageable.
Exact same analysis on companies. It doesn't depend it's small, mid, or large company. I can add there is only one difference is a large cap usually is covered by many analysts, but as we don't rely upon analysts and we mostly rely upon our own contacts, it's basically the same. The only thing we will look at when it comes to large cap is we make a forecast, and if we are very, very different. We will have a very quick look on the consensus. If we think the consensus on large cap is totally irrelevant, that's the only thing, and we will stick to our own forecast. And we don't look at the consensus on mid cap because there is no consensus. But the way we work is exactly the same.
There are no more questions unless someone wants to raise their hand. And so, well, thank you very much, Emeric, Nicola, especially for coming, and Álvaro.
Thank you.
And all the best for the
Thank
future.
you.